Everything you've been taught about investing is actually slowing you down. Most people think building wealth means spreading your money across dozens of assets, checking the market every day, and playing it safe. But the top 1% of investors do the exact opposite. They follow a set of strategies that seem counterintuitive at first, strategies that go against conventional advice, yet consistently deliver superior results. And today, I'm going to break down 5 of these game-changing techniques backed by billion-dollar funds, elite investors, and cold hard data. Now, if you've ever felt overwhelmed by conflicting investment advice, if you don't have the time to research every stock, ETF, and asset class, or if you've ever hesitated before making a move, worried you're missing out on the next opportunity, you're not alone. We're in good company. Smash that like because your boy has been the head of the line on that train. Here's the great news though. The wealthiest investors don't just invest differently, they think differently. They use psychological triggers, rebalancing techniques, and asset allocation methods that allow them to build million-dollar portfolios without constantly monitoring the market. And in this video, I'm pulling back the curtain on their exact playbook, including the 80-20 wealth building strategy used by the top 1%. A little known rebalancing trick that boosts returns by 27%. The exact asset allocation framework behind Yale's $31 billion endowment fund. The psychological triggers that set millionaires apart. A 3-step risk management system that prevents massive losses. And the best part, you don't need to be a finance expert to spend hours managing your portfolio to use these strategies. So smash that like and consider subscribing if this video adds value to you, because you subscribing and liking helps me reach more people with this valuable content. The counterintuitive 80-20 wealth building strategy used by the top 1%. Most people assume that successful investors diversify widely to reduce risk. They believe the safest way to build wealth is by spreading their money across dozens of assets, hedging against market downturns. But the wealthiest investors, they play by a completely different set of rules. They follow the 80-20 principle, a strategy that focuses on concentrated bets in high conviction assets rather than excessive diversification. Instead of owning 50 different stocks, they put the majority of their capital into a handful of carefully selected investments that drive the most returns. Why? Because not all investments contribute equally to your wealth. The majority of gains in a portfolio come from just a few key assets. The 80-20 principle, also known as the Pareto principle, it states that 80% of your results come from 20% of your effort. And in investing, this translates to a simple and powerful idea. A small percentage of your portfolio is going to generate the majority of your returns. The top investors allocate 80% of their capital into safe, wealth-preserving assets, and 20% into high upside asymmetric bets. 80% goes into stable income producing assets, things like index funds, real estate, cash flowing businesses, dividend stocks. 20% is reserved for high growth opportunities, crypto, venture capital, tech startups, disruptive innovations. This way, the 80% acts like a safety net, ensuring steady growth. Meanwhile, that 20% provides massive upside potential. Most investors either play it too safe or get mediocre returns, or go all in on high risk and lose everything in downturns. This 80-20 strategy ensures you capture the biggest market opportunities while never risking your financial future. Take Warren Buffett, for example. While most people imagine he owns hundreds of stocks, the reality is that a huge portion of Berkshire's success has come from just a handful of long-term positions like Apple, Coca-Cola, American Express, or consider Yale's $31 billion endowment. Instead of spreading capital evenly across every asset class, it places heavy emphasis on high return alternatives like venture capital, private equity, allocating far less to traditional assets like bonds and cash. So what's the key takeaway? The wealthiest investors aren't blindly diversifying. They're strategically concentrating on the highest performing assets while maintaining smart risk management. And that brings us to the next strategy, one that can boost your portfolio returns by 27% without adding extra risk. If that's not worth a like and a follow, I don't know what is. Help a brother out. Now let's dig in. Most investors make one of 2 mistakes when managing their portfolio. They either set it and forget it, ever heard that? Or they overreact for market swings. Both can cost them millions in lost gains. Here's the problem. If you never rebalance, your portfolio can drift away from its optimal allocation, exposing you to unnecessary risk. But if you rebalance too much, you're trading instead of investing and can miss out on growth, and you get a lot of fees. So the wealthiest investors use a precision-based rebalancing strategy, one that's rarely talked about but has been shown to boost returns by 27% over time. Instead of rebalancing on a fixed schedule like every quarter or year, they rebalance based on threshold deviation, meaning they only adjust their portfolio when an asset drifts beyond a certain percentage limit. Here's how it works. 1. Set an optimal allocation. Let's say you aim for 60% stocks, 30% bonds, and 10% alternatives. Or maybe you're like me and those stocks, instead of stocks, it's like 60% or 80% crypto. Then instead of bonds, it's stocks. And then alternatives and treasuries and things of that nature. 2, establish deviation thresholds. Instead of rebalancing on a fixed schedule, you only act when an asset class moves 5% beyond its target allocation. 3, execute rebalancing when needed. If stocks grow to 65%, you sell the excess and reinvest in underweighted classes, restoring balance while locking in gains. Why does this work so well? Well, because it forces you to buy low and sell high automatically. Instead of reacting emotionally to market swings, imagine this. The market crashes and stocks plummet. A traditional investor panics and sells at a loss. But someone using this strategy, they rebalance, buying more stocks when they're cheap, positioning themselves for massive gains in the recovery. Or picture this, a bull market sends stocks soaring, right? Never happened before. But instead of letting greed take over, a disciplined investor trims their profit allocation to other assets, preserving their wealth before the market crashes, which it always does in cycles. Fail to rebalance and your portfolio drifts into risky territory, exposing you to devastating losses. Rebalance too rigidly and you sacrifice gains, leaving money on the table that could have compounded over decades. But get it right and you have built a portfolio that grows consistently while protecting itself from major crashes. This is exactly how Yale's $31 billion endowment fund optimizes its asset allocation, prioritizing effective rebalancing over mindless diversification. And speaking of Yale, let's break down the exact allocation framework they use to consistently outperform 95% of investors. The exact asset allocation framework used by Yale's $31 billion endowment fund. Most investors think building wealth means following a simple 60-40 portfolio, 60% stock, 40% bonds. Yawn, that's outdated, seriously. But here's the harsh reality. That strategy is outdated and underperforms in today's market. Meanwhile, Yale's $31 billion endowment fund has quietly outperformed 95% of investors for decades using a radically different approach, one that most people have never even considered. And the strategy? An aggressive shift away from traditional stocks and bonds into high growth alternative assets. Hello, not like I haven't been saying this for years. Here's how Yale structures its portfolio: private equity and venture capital. Now, a lot of you watching this won't have access to that, but you do have access to crypto, and I have a free Crypto Master and Money class that teaches you the fundamental principles so that you don't get screwed and lose all your money, and you grow in more measured approaches in the crypto space. Now back to Yale. 41% they put invested in high growth startups before they go public. They put 21% in that, leveraging advanced strategies to maximize returns in any market. Real assets, real estate, natural resources, that's 15%. It's hedging against inflation and economic downturns. Okay, and foreign equities, like foreign companies, 11%, diversifying into high growth global markets. For bonds and cash, less than 12% is allocated to that, minimizing their exposure to low return assets. And this is completely different from what most investors are told to do. Instead of parking money in index funds and bonds, Yale aggressively allocates capital where the highest returns are found. So how does this work? Well, higher growth potential, private equity and venture capital have historically outperformed public market. Risk-adjusted returns. Hedge funds and real assets act as a shield against volatility. Inflation protection. Unlike bonds, real estate and natural resources hold value especially when inflation strikes. So what happens if you stick to a traditional portfolio? Well, you could be losing millions in potential gains. A 60-40 portfolio has averaged 6 to 8% annual returns, while Yale's strategy has averaged over 12%. You expose yourself to economic shifts. Bonds used to be safe, but rising inflation and interest rate changes can destroy their value. You miss out on the wealth building power of alternative investment, the same asset classes that billionaires use to multiply their fortunes. Now, as I said earlier, most retail investors don't have access to multi-billion-dollar funds, but the core principle here is rethinking diversification, not just spreading money blindly across assets, but choosing high growth, high efficiency investments that actually move the needle for you. And that brings us to the next key element of elite investing, the psychological triggers that separate million-dollar investors from the average one. Most people think investing is all about numbers, analyzing charts, predicting market trends, and picking the right stock. But here's what separates the top 1% from everyone else. Investing is more about psychology than strategy. In fact, even the best investment strategy will fail if you don't have the proper mindset. Rewind and watch that again. See, the difference between a millionaire investor and an average one isn't just their portfolio. It's how they think, react, and make decisions under pressure. So what psychological triggers do the wealthiest investors master? Number one, they use market volatility to their advantage. Most investors panic when markets drop. They sell out of fear, locking in losses and missing the eventual recovery. But successful investors, they train their minds to see volatility as an opportunity, not a threat. In the '08 crash, most people were terrified and sold their investments. Meanwhile, Buffett poured billions into the market, buying up undervalued assets. The result? Massive gains when the market rebounded. And if you can't master this mindset, market crashes will wipe out your gains. But if you do, you'll be the one making money while blood is running in the streets. Two, they automate decision-making to remove emotion. The average investor second guesses themselves constantly, jumping in and out and in and out and in and out and in and out of investments based on emotions. But the top 1% use preset systems that take emotion out of the equation. This is why hedge funds and elite investors use algos and strict rules for buying and selling, because human emotions are the biggest threat to consistent gains. And if you let emotions drive your investments, you'll make reactionary decisions that cost you millions over a lifetime. But if you implement a systematic approach, you'll remove impulse decisions and build long-term scalable wealth. Number three, they focus on asymmetric bets. High upside, limited downside. Most people play it safe with low yield investments, afraid to take calculated risks. But millionaire investors look for asymmetric opportunities. Investments where the upside is huge and the downside, well, it's really limited, it's controlled. Think about early Bitcoin investors. Many were ridiculed, but they saw the potential upside far outweighed the risk. Even if they lost some money, the potential gains were 100 times bigger. And this is also why top investors allocate part of their portfolio to venture capital, private equity, and disruptive technologies, high reward plays where a single win can offset multiple small losses. So if you only play it safe, you'll never build consistent wealth. But if you learn how to make strategic, asymmetric bets, a single investment can change your financial future. Number four, baby. They master the power of long-term thinking. The biggest reason most investors fail? They think in months instead of decades. The wealthiest investors know that real wealth isn't built overnight. It's the result of compounding over years. Look at Bezos. When Amazon was unprofitable in its early years, Wall Street doubted him. But Bezos had a long-term vision, ignoring short-term losses and focusing on the biggest picture. Today, Amazon is worth over $1.5 trillion. So if you're chasing short-term gains, you'll always be stuck in a cycle of fear and reaction. But if you commit to long-term thinking, your portfolio can grow exponentially, even when short-term volatility tries to shake you out. Mastering these psychological triggers is the difference between being controlled by the market and controlling your own financial destiny. And speaking of control, let's talk about the exact 3-step risk management system that prevents major losses while maximizing gains. Most people focus on how much money they can make when investing, but the top 1%, Well, they focus on how much they can lose before they ever think about gains. Because here's the truth. Your ability to build wealth isn't determined by how much you win, it's determined by how well you protect yourself from losses. A single market crash, a bad investment, or even a simple mistake can wipe out years of progress. That's why the most successful investors use a proven risk management system to prevent catastrophic losses while still maximizing growth. And here's how this works. If this is adding value, smash that like right now, and please do consider subscribing, not for my sake, but as you subscribe and like, the algorithms push this to other people so they can get the same benefits you are right now. Now, let's step into step one, the never lose big rule. The mistake average investors make, putting too much money into one single investment. If it goes bad, they lose everything. What elite investors do, they follow strict position sizing rules, never risking more than 1 to 2% of their total portfolio on a single trade. They also use stop loss orders. These are preset limits that automatically sell an asset when it drops beyond a certain percentage. This way, they never let a small loss turn into a massive one. Without position sizing, one bad investment could wipe out your entire portfolio. But with it, even a series of losses won't significantly impact your overall wealth. Step two, the barbell strategy. Imagine holding a barbell in the gym. On one side, you have heavy weights, and on the other, a lighter one for balance. That's exactly how elite investors structure their portfolios. 80 to 90% of their portfolio is in safe, predictable assets, things like index funds, real estate, dividend stocks. The remaining 10 to 20% go into high risk, high reward plays. Crypto, startups, venture capital, emerging technologies. This way they expose themselves to massive upside without risking total financial ruin. And if you don't follow this, you're either too conservative and miss out on massive opportunities, or too aggressive and risk losing everything you've built. The barbell strategy ensures long-term security while still capturing big wins. And as I've said before, if you're starting out and you need to either catch up or you have a little more risk tolerance, put more in to the risk bucket. As it grows, then move it over. So you have you have a larger amount initially to grow, but then take some of that out strategically and put it into the safety bucket so that you don't lose all of your growth. You grow it faster, you're disciplined at a certain percentage, certain dollar amount, you move over some to your safety, and then you have more of a balanced barbell. That's what you want to do, in my opinion, if you're earlier in your investment journey and you feel like you have a little catch up to do, or you just have a higher risk tolerance. But you got to set the percentages at the beginning of when it grows to a certain percent, you move it over. Otherwise, you get screwed. Now, let's get to step three. Step three, the liquidity protection plan. Preparing for market crashes. The biggest financial disasters happen when investors don't have enough cash when they need it most. Think about the '08 financial crisis. Many investors were forced to sell assets at a loss because they didn't have enough liquid cash. Meanwhile, those who had cash reserves, they bought up undervalued assets and made millions or billions. That's why elite investors always keep 10 to 20% of their portfolio in liquid assets, cash, money market funds, short-term bonds, stakes. If you don't have liquidity, you're vulnerable in a downturn. But if you do, you can stay in control and take advantage of market crashes instead of being a victim. This three-step system is the difference between an investor who survives downturns and one who loses everything. And speaking of outperforming the market, let's break down the complete millionaire portfolio strategy. Now that we've broken down the exact strategy used by the top 1% of investors, it's time to put everything together into a foolproof blueprint that you can apply starting today. Does that sound good? Smash that like again, baby. Love from me to you. This is not just theory. This is a step-by-step approach that has helped investors outperform the market, protect their wealth, and build financial freedom with minimal stress. And just as we're talking about a step-by-step approach in money, I wrote extensively in my recent book, Life is Dope, how to do this in our own personal life. You can get all the details down below, baby. So let's dive back into the money part. Step one, the 80-20 portfolio allocation. 80% into stable wealth building assets like index funds, real estate, cash flowing businesses. 20% into high upside asymmetric bets, crypto, startups, disruptive technologies. This ensures steady growth with the potential for massive gains without risking everything. Step 2, the portfolio rebalancing advantage. Every 6 to 12 months, rebalance your portfolio, sell off assets that have grown too large, and reinvest in undervalued opportunities. Remember, this alone can increase returns by 27% over time. Step 3, the Yale endowment model for alternative assets. Reduce reliance on bonds. Instead, diversify into real estate, venture capital, private equity, hedge fund style strategies, crypto, okay? Allocate at least 20 to 30% of global stocks for higher growth potential. This is how the smartest institutions and billionaires manage their wealth. Step 4, mastering investor psychology. Avoid emotional decision making. Don't panic sell in downturns or chase hype during bull runs. Use system-based investing. Have a clear buy and sell framework to stay disciplined. Okay? Train yourself to think long term. The best investors hold assets for decades, not months. Let that sink in. Step 5, the 3-step risk management system. Set clear investment rules. Know your max risk per trade and never overextend. Second, use stop loss strategy and hedging. Protect your downside while staying in the game. Always keep a cash reserve. Dry powder allows you to buy when the markets crash. At this point, you have everything you need to start building a millionaire portfolio. The question is, will you take action? Pick at least one thing from this video and implement it today. Drop a comment and let me know what it is. Because in investing, the biggest cost isn't a bad decision, it's inaction. The wealthy understand this. Now, my friend, give me a fist bump, boom, because it's your turn. And I will see you on another video right after you smash that like and consider subscribing. Lots of love. You keep living your life to the fullest. Peace.